have with us Ravi Lamba, who is the joint head of India operations of Temasek. Ravi, so good to have you on CNBC TV 18. Now, of course, your annual review that has just come out for FY17, that shows that there is a gain of 13% in the overall portfolio and the worth that you have globally, and now you are almost a $200 billion fund globally. But you still remain a net seller for the last year, $16 billion worth of investments made globally, while you have sold and divested worth about $18 billion. Is that trend going to continue, and why did we see you as a net seller last year?
Sure. No, thank you. I think we do not manage the portfolio on a year-to-year basis for sure. We look at a long-term view. 10, 20 years is how we think about the portfolio. And last year was a year where we had a more measured pace towards investments. You know, there were some macro trends that we were being cautious about. There was you know, uncertainties in various parts of the world, which was reflecting on our macro views, and therefore we took the opportunity to be more measured in the way we deployed capital. And where we thought it was a good time to divest, we did divest, and it so happened that we sold more than we invested. But it does reflect the fact that we had a more measured pace on investments last year.
All right, and the equity market valuations also have a lot to do with that.
Yes, indeed. Equity valuations across the globe have been stretched. You know, the U.S. is trading at, you know, probably a 10-year high. Many markets have been stretched, and that obviously gives you the right time to pause and see whether you should take money off or not. You know, more than 60% of our portfolio is in listed equity, so the fact that our portfolio is at a record high of 274 billion Sing dollars is a reflection of the fact that the markets have gone up.
Right. As far as India is concerned, how are you positioned in India? What part of your portfolio is invested in India, and the outlook going forward?
Sure. We continue to be positive on India. Our total gross exposure in India has grown from last year. We are about 5% of the portfolio. Because the portfolio has grown, our exposure has grown as well. You know, India is in a spot where we think it's a favorable time to continue to invest. You know, the fiscal deficit is in good control. Current account deficit is in control. Inflation is at, you know, is at a low point right now. We find that the FDI has been pretty solid. India has been a big recipient of capital indirectly, and then, you know, the policy reforms and the structural reforms that are taking place, we think are here to stay, and we think there's a longer-term path where these will play out quite well. So if I put all of that together, you know, we have a positive view, and that's reflected on the way we are investing in India.
All right. So 5% of your total portfolio, if it's in India, it is close to about $10 billion. How much more deployment could come? At least what's the plan for FY18 from this side?
Right. As you know, we don't manage our portfolio with any predetermined allocation to country or to sector globally. So we are bottom-up investment driven. The fact that it's 5%, close to 10 billion, I think is a matter of result of how we have bottom-up managed the investments and investments. So all I would say is I think we are positively biased, and, you know, we will continue to look for opportunities in India.
All right. So I was just looking at your portfolio in India, and you have a fair bit of, you know, companies which are at a very mature stage, not growth stage, but more mature stage. Is there a reason behind that?
Look, again, I think we are driven by what I would call our investment thesis and intrinsic value as we think about our portfolio. You're right, there are some investments, not just in India, but globally, that are mature businesses. You know, you could say our telecom exposure globally, which we have right now, is a mature industry. But within mature doesn't mean there's no growth. There's still growth. Growth could be coming through different ways. It could be dividend-based growth, or it could be other kinds of growth. It could be through consolidation that could be expected. So there are many different ways that I look at mature investments. So I don't differentiate mature versus growth. At the end of the day, if the investment thesis proves right, we will stay invested. If the thesis if we think the intrinsic value test has played out, then, you know, we will divest. We are entirely flexible in the way we manage our investment portfolio.
Going with your caution towards the publicly listed companies, and you say that the equity markets valuations are stretched. So you have fair bit of companies in the listed space currently. Is that going to change over time now?
Again, we will not manage, and we do not manage our portfolio based on a predetermined sort of notion of whether we should invest in listed or unlisted. We will simply be driven by intrinsic value. So what I mean by that is whether it's a listed company. In a listed company, obviously, we have more flexibility to exit and enter, right? So there are many cases where we will invest in a company at a certain valuation. If it goes beyond our investment, our certain intrinsic value, we'll sell, and when it comes down, we'll buy again. So in a 10-year horizon, there will be several companies that we have invested, divested, and invested again. So the fact that valuations are high right now means we'll be more careful about putting money in companies that we believe to be overvalued to the above our intrinsic value. And we will probably focus more on the private space because there's a little bit more room to negotiate because the public market is what it is.
So let's talk about some of those pockets that you're invested in. So Ravi, looking at the portfolio, there are 3 companies at least on the verge of an IPO where it can be value unlocking for you. It's NSC, SBI Life, as well as Godrej Agrovet. Is that part of the strategy? Are you going to also have fair bit of realizations and fair bit of exits also made because the equity market valuations have been high?
So really, it's the divestment of a company that is now listed is based again on an intrinsic value test because that intrinsic value changes from time to time. So NSE, for example, you know, it's the one that is currently the DRHP has been filed. It's been noted there that we are selling a portion of our stake.
Yes.
And that is exactly based on this particular investment philosophy.
All right, so a fair bit of listings to be seen in your portfolio companies, but a large part of that also comes in from the financial services space. What do you have to say about the valuations currently, and are you happy with the mark-to-market valuations that you're getting in your portfolio here?
I mean, the fact that our portfolio is where it is, I think we're obviously happy.
Yes.
But look, when valuations get stretched, you also have a measured view, and valuations could correct. And there are global events yet to play out. Which could impact equity markets, like the sort of the interest rate cycle. We're going to have to see what impact that has as the Fed in the U.S. takes a decision on interest rates, and we have to see as that normalizes, there will be an impact on the equity markets, and we have to see which companies will be well placed to offset that normalization of value through interest rate movements through their own net income profit growth over a period of time. What I would say to you is that in India, we're focused on India being a consumption-driven economy.
Yes.
Financial services plays very well into the consumption theme.
Yes.
In fact, it's at the heart of the consumption theme, like credit growth and all of that. So as long as we are positive on consumption growth, our view on sectors that are linked to consumption growth will always be positive. And our broad themes are transforming economies and rising middle income populations, and all of that is driven by consumption.
Would you at these valuations still invest in the sector?
Yeah, we would take a view on whether or not we would invest at this valuation or we would wait. But we don't take that. Our view on valuation is not a point in time. It is over a period of time, right? So in the financial services sector, we were. We have reported that HDFC was one where we increased our stake last year because we feel positive about the momentum in the sector. We are also invested in 2 other banks. So ultimately, it's a sector that we think plays very well to India's growth.
All right. So you have investment in HDFC Bank, ICICI Bank, ICICI Pru, you had investments, and Axis Bank. Now,
and SBI Life as well.
SBI Life as an insurance company. Now, your portfolio globally has also benefited because of your investments in Standard Chartered Bank. So does that give you more hope, and are you now refocusing on more banks in India in the coming times?
No, again, we're not allocating based on how much should go into a bank, how much should go into insurance, how much should go into...
Yeah, but as a sector, is that looking still more attractive?
I think financial services continues to be an attractive sector given the consumption theme. I will put it that way.
All right, so there are various pockets in financial services, and one is different from the other. So if I talk about banks, separately insurance, you have tested yourself there, and there are NBFC space as well, and you have a small bit of investment there. So which is the pocket that you're most, maybe enthusiastic about for investments in this space?
I would say all of them.
All right.
Because all of them play to credit growth. And credit growth drives consumption, credit growth drives companies' ability to spend. All of that is linked. So you have to start, you see, the background is when we enter a market, we look at banks as a proxy to economic growth, right? And that's how we entered India first. That's how we entered China first. We went to the banks because they were a proxy to economic growth. As we got more familiar, we started investing in the various sectors that were themselves driving growth, whether it was technology, whether it was consumer, whether it was healthcare, etc. So ultimately, the banks will always play that baseline growth for us. The financial services will always play that growth for us.
Definitely. And are you also excited about the consolidation that this space is seeing?
I think consolidation is, again, is a matter of what industry is driving itself to and how it's preparing itself for whatever ultimately is the end game, which to me always has to be more relevance with your customers. Consolidation is a matter of relevance and doing your business better. And I think in financial services, because the economy is so large, because there's so much demand for financial services, you'll always have companies that will seek a better end with consolidation, and some may not want to do it. So I think we have to watch consolidation for what it means for the combined business.
Have you watched this particular situation closely, where Shriram Transport Finance, where you have a small investment that's looking to merge with the IDFC Group? So what is your view on these kind of situations? As a minority shareholder, what's your view in that particular thing?
So again, ultimately, if the two companies decide to merge, and I have no preview of information because we're simply a small public shareholder in the company, we will take a view at that time whether we want to increase our stake or not. I think, to me, the merger is a function of determining what the consolidated company looks like, and then you decide whether how you want to invest in that business. I would not want to comment specifically on any one particular company or any one particular development, because we will look at it as we look at any other investment.
All right, consolidation also happening in e-commerce, or probably I would say hitting a roadblock as far as Snapdeal, Flipkart is concerned. You have a fair bit of you have investments in Snapdeal as well. How do you see this space, and consolidation is the end game? Is the need of the hour in this space?
So e-commerce has been a theme that we like to invest in for quite a fair bit of time. We have invested in e-commerce across the world, actually.
Yes, Alibaba is a big.
Well, China, Europe, we're in Farfetch. In the US, we're in Fanatics. In Brazil, we're in Netshoes. In Southeast Asia, we're in Lazada. So, in India, we have a small investment in Snapdeal. But our journey in e-commerce has been long, but we think the journey in e-commerce has just started. So our investment in Snapdeal was done at a time when it was still very early. And our view in these early growth companies is we take a stake, a small stake, at an early time, and we watch how it grows. And then we may double down, like we have in a company like Cartrade in India, for example, where we put more capital, or we may not. But we do think the e-commerce journey is still very long. It has just started, and we want to continue to watch it and see how we'll deploy more capital in e-commerce. We've also reported that we've invested in Amazon globally, so we're exposed in e-commerce that Amazon does in India, for example.